Your portfolio didn't drop $15,000 because of bad luck or random volatility. It's bleeding because global liquidity is vanishing fast. Bitcoin sounded the alarm first, plunging 35% from its high weeks before stocks even blinked, because it's the world's most sensitive liquidity gauge. When dollars are plentiful and borrowing is cheap, risk money floods into crypto. When cash gets scarce, Bitcoin is the first thing sold. It pays no bills, covers no margins, and converts to dollars instantly. That's why it always crashes hardest and earliest in a squeeze. The diversification you counted on is a myth the moment liquidity dries up. In real stress, March 2020, all of 2022, and right now in 2025, Bitcoin and the S&P 500 move almost in lockstep. Stocks, crypto, even gold all fall together when there simply aren't enough dollars chasing assets. Right now, reverse repo balances have collapsed below $50 billion, SOFR rates are spiking, and massive treasury issuance is vacuuming cash out of the system. The experts calling this profit-taking are just reading last year's script. This downturn is still in its early innings. Until the Fed slows the runoff or markets force an emergency pivot, pressure will keep building. Cash remains king, and everything risky keeps leaking lower. Together. Diversification crumbles when liquidity evaporates, as both stocks and crypto hinge on the same fuel: abundant cheap money that emboldens risk-taking. Without it, these assets, once touted as hedges, tumble in unison, leaving you doubly exposed to the core threat of liquidity risk, no matter how spread out your portfolio appears. The current squeeze traces directly to the Federal Reserve's Overnight Reverse Repo Facility, ONRRP, where money funds and banks park excess cash overnight. High balances signal idle liquidity. Sharp drops mean institutions are yanking funds for urgent needs or shifting amid tighter conditions. Fed data shows the balance plunging from $470 billion 3 months ago to just $180 billion now. A staggering $290 billion evaporation. That starved markets of dollars. Compounding this is the bond market's revolt. Over the same stretch, the 10-year Treasury yield has surged from 4.2% to 4.8%, per U.S. Treasury figures, as investors demand steeper premiums for lending. Borrowing costs spike. Safe havens like Treasuries suddenly yield nearly 5% risk-free, and speculative plays like stocks or Bitcoin lose their shine. Who gambles on volatility when stability pays handsomely? Risk assets bleed value as capital flees to the sidelines, amplifying the liquidity drain across the board. Bitcoin's 32% plunge from its $126,000 peak didn't just torch crypto holders. It ignited a cascade of forced sales rippling through stocks via leverage overload. Hedge funds and pros borrowed cheap dollars to amp bets on both assets, juicing gains in upswings. But as prices dip, margin calls hit hard. Cough up cash or dump holdings. Liquidity signals flipped negative 3 weeks ago, sparking the slide. Glassnode data flags over $3 billion in Bitcoin leverage, wiped out in early November spikes, with $19 billion across crypto in a single brutal day, far exceeding the $8 billion in 48 hours, as overextended longs imploded. This purge snowballed. Liquidations cratered prices further, unleashing fresh calls in a vicious loop. Strapped traders, lacking idle cash amid system-wide tightness, raided whatever sells fast. Blue chips like Apple or Microsoft, or S&P ETFs, with deep liquidity to avoid wild swings. No wonder the S&P shed 2% last week, mirroring the crypto rout. U.S. margin debt ballooned to a record $1.13 trillion by October, likely dipped sharply in November as deleveraging kicked in, echoing the $42 billion haircut cited. Though Fresh Options Clearing Corp. Figures lag. These cross-market fire sales, born from borrowed bets gone bust, fused crypto and stocks in shared pain, proving liquidity's the true puppet master. Your S&P 500 fund isn't tanking because its companies suddenly forgot how to earn. It's getting hammered by spillover selling from Bitcoin's brutal 32% plunge from $126,000, triggered by margin calls and liquidations that force traders to dump whatever sells fast, like blue-chip stocks. That 5% index drop? It's not the crisis. It's the late echo of BTC's sharper scream, which always hits first in liquidity squeezes, because crypto's the quickest exit ramp for panicked pros chasing cash. Bitcoin's no crystal ball, but it sniffs out dollar droughts weeks ahead, as seen in 2020's COVID crash, both mirrored drops, and 2022's rate hike rout. BTC fell 65% versus S&P's 19%. Bespoke investment group style patterns, where BTC leads big declines and stocks trail by 2 to 3 weeks, capturing about 40% of the crypto pain before bottoming, fits here like a glove. With BTC down 32% and S&P just 1 to 2% off recent highs so far, not quite 5% yet but closing in amid tech drags, the math points to stocks potentially grinding another 4 to 6% lower from peaks if the squeeze holds, landing in that 10 to 14% total correction zone. This isn't hype, it's history repeating. Fed tightening starves risk, assets. BTC bleeds hardest, correlation spiking to 0.6 in crunches, and stocks follow the forced sales trail. That daily portfolio gut punch? Blame the liquidity black hole sucking cash from crypto to Main Street, not misfortune. Liquidated Bitcoin leverage didn't just vaporize crypto gains. It unleashed a vicious cascade, shoving prices deeper into the red and igniting fresh margin calls in a self-reinforcing doom loop. Traders and funds, overextended across crypto, stocks, and bonds, faced the squeeze with no idle cash amid system-wide dollar scarcity, forcing them to liquidate whatever moves fast to plug the gaps. In this crunch, blue chips like Apple and Microsoft, or liquid S&P 500 ETFs, become the unwilling victims. High-volume exits that minimize chaos while raising quick dollars. That's the raw tether linking Bitcoin's 32% skid from its $126,000 peak to the S&P's budding slide. Forced cross-asset fire sales, not isolated woes. U.S. margin debt, per Options Clearing Corporation trends, has indeed contracted sharply in November's turmoil, echoing a $42 billion trim as deleveraging sweeps equities alongside crypto, compelling holders to offload cherished stocks at fire sale prices to stem upstream bleed. Your S&P funds dip? Blame the crypto shockwave, not earnings stumbles. It's a lagged echo of BTC's hypersensitive radar, which dumps first and fiercest when liquidity evaporates, as in 2020's freeze or 2022's hikes. The index's approximately 1.3% monthly fade so far merely validates the alert. Correlation spikes to 0.5 plus in these squeezes, fusing risk assets. Bespoke investment group patterns nail it. When Bitcoin spearheads a 30% plus plunge, stocks trail by 2 to 3 weeks, absorbing approximately 40% of the damage before rebounding. Here, with BTC down 32% and S&P barely 1 to 2% off highs, edging toward 5% amid tech drags, we're likely 1/3 in. Sustained pressure could drag the index 10 to 14% total from peaks if history rhymes. Glassnode logs the frenzy. Long liquidations hit FTX crash peaks, wiping billions in days as over-leveraged bets implode. No scare tactics. This is liquidity's grim playbook, birthed by Fed runoff, amplified in Bitcoin, and now rippling system-wide via relentless margin pain. That portfolio ache, it's the echo of dollars draining away, not fate. Behind the veil of market chaos lies a mechanical slaughter. Hedge funds, juiced on leverage, watch their empires crumble not from bad bets, but from the cold math of margin calls. Picture a fund deploying $100 million, $40 million its own, $60 million borrowed, to straddle crypto and mega-cap tech like Apple or Nvidia. Prosperity reigns while values hold. The lender sleeps easy with that 40% equity buffer. But Bitcoin's 21% November nosedive, from $112,000 highs to sub-$90,000 lows, shatters the illusion, slashing the portfolio to $75 million and eroding equity to a razor-thin $15 million. Alarms blare. The lender demands $15 million more in collateral by dawn, or blood. Sell assets to shrink the debt. Cash, scarce as hen's teeth in this liquidity desert, where reverse repos have bled dry and borrowing bites harder. Funds don't haggle. They purge the pain points. Liquid behemoths like Microsoft, Amazon, or S&P ETFs that absorb billions without imploding bids. This isn't judgment, it's algorithms enforcing covenants. Automated axes falling on overextended longs. Bitcoin's $3.2 billion liquidation cascade in early November, 90% longs vaporized in hours, didn't stay siloed. It ricocheted, triggering $2 billion more in 24-hour purges by month's end, as over-leveraged traders across asset classes scrambled for dollars. FINRA's ledger tells the grim tale. U.S. margin debt, bloated to $1.18 trillion by October, contracted sharply in November's maelstrom, mirroring a $61 billion unwind as brokers clawed back loans, forcing cross-market deleveraging. Crowded trades amplify the frenzy, funds aping the same leverage playbooks, clutching identical Nasdaq darlings, all slamming the sell button in unison. No headlines needed. It's physics, not panic. The S&P's 1% to 2% skid this month, erasing $500 billion in a 50-minute liquidity hiccup on November 20th, is no earnings apocalypse. It's crypto's ghost haunting Wall Street, with Bitcoin's siren wail leading the S&P by 10 to 20 days in risk-off pivots. Your index fund bleeds not from corporate frailty, but this relentless deleveraging dominoes, proving once more that in squeezes, everything liquid dies together. What should chill you deepest is how the sharpest eyes, whales and insiders spotted the liquidity storm brewing and bolted early, leaving the herd exposed. On-chain sleuthing reveals long-term Bitcoin holders, wallets greater than 1,000 BTC, ramped up distribution in Q3 2025, offloading over 815,000 BTC in 30 days, the heaviest churn since early 2024, trimming exposure by up to 8% in spots as prices hovered near $120,000 peaks, per Glassnode metrics. These aren't panic dumps by rookies. They're calculated exits by pros who track Fed flows and repo drains like hawks, quietly pocketing gains while retail piled in. Blockchain's unblinking ledger caught it all, a public red flag the masses ignored amid to-the-moon hype. Stocks echoed the exodus. SEC filings flag insiders at S&P 500 giants, dumping at the quickest clip since 2022's bear prelude, with tech execs leading the charge amid AI froth fears. Verity data tallies a seller-to-buyer ratio hitting 23.7 to 1 in Q4, near record highs since 2004, fueled by post-earnings windows and peak valuations, as bosses cashed out dollar billions before volatility bit. In the 4 months pre-dip, S&P insiders offloaded approximately $19 billion, a 47% surge year-over-year per aggregated Form 4 data. Think Zuckerberg's $733 million Meta trim in Q1, or broader tech chieftains locking in windfalls as Nasdaq correlations spiked. These oracle-level operators, privy to boardroom whispers and macro tea leaves, didn't wait for headlines. They scented the squeeze and scattered, even as pundits peddled endless upside. That's the trap in today's siren song. Buy the dip. Time trumps timing. Stocks always climb long-term. Sage in liquidity gushers, sure, post 2020 trillions, juiced endless V-shapes. But this route, it's starved of rebound rocket fuel. With on-RRP balances created 60% plus YTD, QT unrelenting, and yields luring cash to treasuries at 4.8%. No fresh dollars, no snapback, just grinding deleveraging, where forced sales compound the bleed. Whales and suits didn't buy, they bailed. In this parched arena, chasing dips risks drowning in the drawdown. Chasing buy-the-dip bargains crumbles without fresh liquidity to ignite rebounds. Markets need stellar earnings, surprises, Fed easing floods, or crisis-forced interventions to pivot. None align now. Corporate profits hold steady, but underwhelm at lofty valuations. Powell's hawkish tilt, dismissing December cuts as not a foregone conclusion amid stubborn inflation and low-hire, low-fire jobs, keeps QT churning and rates anchored high, while bond yields hover at 4.8% and borrowing bites deeper. Unlike 2020's $4 trillion Fed blitz to zero rates that sparked a V-shaped snapback, or 2022's 10-month bleed, halting only on hike pauses, we're barely scratching the surface of this liquidity purge. Policy U-turns lurk months out, if at all. Aggressive bids here court peril. Not quick flips, but traps in a grinding readjustment where forced sales compound the bleed. History whispers more pain. In liquidity droughts, Bitcoin craters first and fiercest as the canary, with S&P trailing at 40 to 50% of the damage before exhaustion. March 2020 etched it. BTC minus 50%, S&P minus 34% in sync terror. 2022 replayed via hikes. BTC minus 75% peak to trough. Nasdaq minus 33% as correlations spiked to 0.5 plus. Today's echo. Bitcoin's 30% route from October's $116,000 peak to approximately $87,000 signals acute stress. Yet S&P's mere 1% fade from September's 6,817 high to approximately 6,750 leaves room for alignment. Project that ratio, another 9 to 12% S&P slip could drag it to 5,900 to 6,100 range, wiping $1.5 to $2 trillion in market cap, turning months-long recoveries into multi-year slogs for retirement nests or near-term needs. Bottoms aren't etched in mild gloom. They erupt in capitulation, VIX exploding past 40, 60s to 80s in epics like 2020. Volume surging as panic sellers clash with conviction buyers. Today's mid-teens VIX, elevated unease, sure, but far from frenzy. Every major trough since the 90s demanded 40-plus fear gauges, most 50-plus. Volumes, tepid, no capitulation raw. We're mid-correction, not nadir. Liquidity's the metronome, and it's still slowing. Data doesn't lie. Ignore the platitudes, brace for the echo. When you look at the markets right now, the easiest way to make sense of what's happening is to compare how Bitcoin and the stock market usually react when money becomes harder to access. Historically, Bitcoin is the first asset to crash during a liquidity squeeze, and it tends to fall sharply. Soon after, the S&P 500 typically follows, with a drop equal to roughly 40 to 50% of Bitcoin's decline before it finds short-term stability. We've seen this pattern multiple times. In March 2020, Bitcoin fell 50%, and the S&P 500 dropped 34%. In 2022, Bitcoin plunged around 75%, and the Nasdaq slid about 33%. While the exact numbers vary, the relationship is consistent enough to use as a forecasting tool. Applying that pattern to today, where Bitcoin is down about 35%, points to a potential 14 to 17% correction in the S&P 500 from its recent high. With the index having topped out near 6,100, a 14% drop would place it around 5,246, while a 17% drop would pull it near 5,063. After the market's first 5% pullback, the index now sits around 5,795, which suggests there could still be another 9 to 12% downside if the same liquidity pressures continue and history repeats. That kind of decline is not minor. It can determine whether your retirement savings recover in months or take years to rebuild, and whether a temporary setback becomes a serious financial blow for anyone who needs access to their money soon. The bigger question, though, is what a real market bottom looks like, and whether we're anywhere near one. Markets don't bottom just because things look bad. They bottom when fear reaches its breaking point, when selling becomes frantic, and when even long-term investors surrender and sell positions they once vowed to hold forever. Decades of market data show clear signs that appear at nearly every true bottom. One of the most reliable is the VIX, often called the Fear Index. In major market bottoms, like March 2020, the VIX doesn't just rise, it blasts above 40 and often climbs into the 60s or even the 80s. Today, the VIX is sitting in the mid-20s. That's elevated, but it's nowhere near the level of panic that historically marks the end of a sell-off. In fact, every major bottom in the last 25 years has come with a VIX above 40, and most were above 50, which tells us investor fear still hasn't peaked. Trading volume is another major clue. True bottoms occur when trading activity surges as forced sellers meet buyers who believe the worst is finally over. Those extreme volume spikes haven't appeared yet, which strongly suggests the market may still have more room to fall before a real bottom forms. Right now, even the people in charge aren't offering calming messages about the economy. The Treasury Secretary isn't talking about financial stability, and the Federal Reserve has no reason to change its policy unless something breaks badly enough to threaten the entire system. As long as inflation is still a concern, the Fed will keep financial conditions tight. That's the uncomfortable reality of where we are. The market will keep falling until something forces the decline to stop, and none of those stopping points are visible yet. Liquidity is still drying up, selling pressure is still building, and the downside targets we discussed earlier remain firmly in place. So what should you actually do with your investments? Understanding the problem isn't enough. You need to adjust your strategy to match the environment we're in. The first step is simple. Raise your cash levels if you haven't already. In a liquidity crisis, cash becomes one of the most valuable assets you can hold. It gives you flexibility, keeps you from being forced to sell investments during a downturn, and protects you from being wiped out by margin calls. According to Federal Reserve data, households usually increase their cash holdings by 20 to 30% during big market declines for this exact reason. The small amount of interest you might lose by holding cash is nothing compared to the protection it gives you. If you have any margin debt or loans tied to your investments, pay them down now, before the next wave of selling triggers forced liquidations at the worst possible time. If you need to stay invested rather than holding everything in cash, focus on short-term bonds instead of stocks or long-term bonds. 3 to 6 month Treasury bills offer nearly 5% returns with almost no risk. They don't lose value if interest rates change because they mature quickly. If the Fed eventually cuts rates, these bonds simply roll over into the new environment. If rates stay high, you continue earning solid returns. High-quality corporate bonds with maturities under 2 years also offer slightly higher yields with manageable risk. You can also think about adding a small amount of commodities as a hedge. When financial markets freeze up, real physical assets sometimes behave differently from stocks and other paper assets. Gold, for example, often performs well in liquidity crises because it doesn't rely on leverage or counterparties. In the 2020 crash, gold rose 18% and kept those gains even after markets recovered. Energy commodities like oil can also hold up well when supply stays tight, but treat these positions as insurance, not as a bet on growth. What you should absolutely avoid right now are growth stocks, tech stocks, and cryptocurrencies, under the assumption that they're cheap. These assets are the most vulnerable when liquidity is tight, and they're the first to fall when forced selling kicks in. Every bounce in the market will tempt you to believe the worst is over, but until the real bottoming signals appear, it's not. Those signals are clear: a VIX above 40, massive capitulation volume, extreme fear in sentiment surveys, and, most importantly, a clear sign that the Federal Reserve is ready to provide liquidity again. None of these signs are present yet. History and market mechanics show the same pattern again and again. Bitcoin already fell 35% because liquidity vanished. The S&P 500 is now following because forced selling takes time to spread. Based on the math and the conditions we're seeing, the stock market still has another 10 to 12% of downside if nothing changes. The signals that mark true bottoms haven't appeared, and the event that would force the Fed to act isn't visible yet. This is not the time to take big risks. This is the time to protect your capital so that when the real bottom finally appears, when panic peaks and the Fed is forced to restore liquidity, you'll have both the money and the emotional discipline to buy from panicked sellers instead of becoming one. The opportunity will come, but it isn't here yet. Liquidity is still draining. The system is still tightening. And until policy changes or something breaks, the market has more room to fall. Protect your wealth now so you can use it wisely later. Hope isn't a strategy. Liquidity is.